Alrighty. So I've already created a number of cover call videos and you can go and check them out, but they're mostly on entries and as well as rolling cover calls. And I haven't really covered one on exit strategies. So I've got a number of people who are requesting, to create a video on how to exit the cover calls, how to close them. So I'm going to share with you a few exit strategies in this video so you can use them for yourself as well. So the very first exit strategy is what I call till expiration do us part. So this is a pun on marriage where they have the vow where it's till death do us part. So basically you just keep on to your cover call until it expires worthless. So there are two ways to do it, right? So the first way is if you're willing to get assigned, right, you can just simply wait until the cover call get assigned or expires worthless. So what this does is that it actually gives a chance for your cover call to get out of the money if it's in the money. So for example, if the stock, let's say goes up to this point, you decided to sell a covered call. So if it goes up and then you do not roll it, sometimes there's a chance that it could go up and then go back down and then it closes out of the money. This way your covered call expires and then you can go ahead and sell another covered call. So this is the first way. The second way is that you can just keep rolling until your covered call finally expires. So for example, if you, let's say, sell a covered call at this point, so at this point you have a cover call and the stock continues to move up past this point. So at this point maybe you say that you want to roll up your covered call, so you could roll up to this point, and then if the market goes up again, right, let's say it goes up, right, you can roll it again depending on how far you can get a roll. Maybe this time when you roll it's still slightly in the money, okay, and then you just wait for it, right? So maybe there's a chance if you cannot roll for any more credit, you could just wait and see if the market maybe eventually goes down and your cover call expires worthless. All right, so very simple for this. So the next one is to set a fixed percentage to take profit. All right, so this is the most hands-off approach. Very simple. The moment when you sell your cover call, you can immediately place a limit order to place your take profit for it, right? So it can be 50%, 80%, or 90%. These are the most common numbers, right? So if you want to just quickly take profit on it, you can just go for 50%, because a lot of the time, let's say if you sell a 30 days cover call, right, a lot of the time if the market moves away from the cover call, let's say the market goes down, you notice that you can easily achieve this 50% in just maybe even the first week after selling this cover call. So you can just close it out automatically, right? Some people like to wait until most of the premium has been taken out, maybe about 80% or 90%. So there's very little management needed, and you can set a take profit order after placing the cover call. All right, so this exit strategy number 2. Now, exit strategy number 3 is to take a loss for capital gains. All right, so basically what it means is to take a loss on your covered call in exchange for potential capital gains on the underlying stock. So I give you an example. Let's say, for example, the stock is here and then your covered call is already in the money, right? You already got a covered call in the money, and let's say it's at the strike of 100. Now, at this point of time, you want to roll to the next level. Let's say the next available level that you want to roll is 110, but you notice that if you want to roll, it will be for a debit, which means to say that you will have to pay to roll, which is normally not the ideal scenario which we want, because whenever we want to roll our cover calls, we always want to roll for credit. But there'll be times when you notice that you can't exactly roll for a credit unless you really roll all the way very far out in time, maybe to 6 months later. But that's not really ideal for a cover call, right? Ideally for the cover call, we want to have it around the 45 days mark. So let's say at this point of time, the stock is already in the money for your first cover call and you want to roll to the 110, you notice that maybe you may have to pay a debit. So for example, maybe this time you may have to pay a $5 debit, right? So if you have to pay a $5 debit, what do you gain, right? So there is the gain of $10 in terms of intrinsic value on your underlying stock. So what this means is that you are giving up $5. Alright, you're paying out $5, but you can gain $10. That means your net would be a positive $5 if the market actually goes up above this strike price 110 at expiration date. So this way you'll be able to earn the additional $5 on intrinsic value. Right, so I'm going to give you an example on one of the trades which I did. So this was a poor man's cover call which I did on a UNH, United Health Group. So basically on this date, I entered into a poor man's cover call, right? This is on the 1st of October. You can see the date down here, right? So I bought a poor man cover call. I got a pretty good entry, I must say. So this is the leaps. I bought a deep in the money call, and you can see that the break-even price for this is simply you take the strike price, which is 200, plus what I paid for it. The debit is 187. So the break-even price is 387.72. All right, so it's around 388. All right, close to 390. As you can see, this is at this point in time when the market retraced. At the same time, I sold a covered call at the 410 strike price. So this is my a covered call on the lips, so this becomes a poor man covered call. All right, let's see what happened next. So on the 11th of October, as you can see, the market went to my strike price of 410. So at this point of time, I decided to roll it up. But I noticed that when I want to roll it out, I decided to roll 2 weeks out. So when I roll 2 weeks out, the next available strike is 10 points away. Now to roll at 10 points away, I couldn't get a credit, right? If I wanted a credit, I have to roll further out, but I didn't want to roll that far out because at the point in time when I entered into my poor man's cover call, only about 9 days have passed, 10 days have passed. So if I were to roll to a further expiration date, I felt it would be a little bit too far at the point of time. So I didn't want that. So I wanted to roll to the next available expiration date, which is just 2 weeks away. So in this case, the best I could get was a debit for it. So then I have to pay $2.60. So I have to weigh my odds, you know. So I'm going to give up $2.60, right? I'm going to pay out $2.60, but I do have a potential gain of 10 points, right? Because I wrote from 410 to 420. So at this point of time, it comes down to whether I feel that the market still has potential to really go up. So for me, I felt that yes, I think UNH will continue to go up based on what I saw on the technicals. So I decided to do this roll for a debit. Again, I do not recommend it if you do not know whether the underlying will go up, if you're not confident about it. But in this case, I felt pretty confident that it was going to go up, so instead I decided to just roll for a debit. So this way I gained a potential $7.40. So I make $7.40 in intrinsic value on the poor man's cover call, on the lips rather, on the long call lips, if the market does go up above this 420 strike price. So I'm giving up 260, but I'm going to gain 740 in terms of intrinsic value. All right, so what happened next on the November, the 1st of November? True enough, the market went above my cover call at the point of time, which was at 420. So 420 was at this point down here. So you can see that the market really blew past this strike price all the way to around 460. So at this point of time, I decided to make another big roll. So this is a big roll from 420 to 440. So this is a 20 points roll from here to here. And this time again, it's for a debit. So again, I have to ask myself at this point in time, right? Do I feel the market is going to go up? So a lot of times, if you feel it's not going to go up, you don't want to do this roll. But I just felt that it was going to go up, right? I had a look at the chart, and I just had a strong feeling that it was going to go up in the long term. May not be in the intermediate term, but could be in the long term. It could go up. So that is why I wanted to roll this up to give me more room for the leaps to make money. So in this case, what am I giving up? I'm giving up about $15, but I'm going to gain roughly $5, right, in intrinsic value. So is this a worth it trade? This is only a worth it trade if you feel that the market is going to go above your strike price. And in this case, you can see the market has already gone well past the strike price. So anyway, even though if it drops somewhere around here, it's still above this strike price, which means I would have captured this $5 in intrinsic value gain on the leaps. Because if I had just rolled to the same level, 420, I may just get a little bit more credit, but I would miss out on this additional intrinsic value gain. So that's what I decided to do. So I rolled it up to 440. So let's see what happened next. The market in the end did come down. It retraced back down to around 440. So at this point of time, I felt alright, it's a good time for me to roll again, because if you watch my video on the rolling, then you would know that when the market is right at your strike price of a covered call, it has the highest extrinsic value. So that's when you have the highest extrinsic value transfer to the following expiration date. So this is where I decided to roll, this time to 450, and you can see this time is for a credit, so it's no longer for a debit. So I did this again. So this time the market blew past again. So this time I decided to roll again. But this time I decided to roll to a much further date because it became a little bit too deep in the money already at this point. And I didn't want to roll for another debit because I already rolled for quite a number of debits. So this time I decided to just roll up another 20 points and roll to as far of a date I can to get a credit for this 470 roll. So later on, I started to roll again another 5 points, and then somewhere towards the end down here, this is where I decided to close out this whole position, and then I was able to make a pretty nice gain on this. So if I hadn't rolled up in the first place from this point to this point, I would probably have my covered call stuck somewhere around here if I wanted the same expiration date. But because I rolled twice to take a loss on the covered call, but then overall I still have an intrinsic value gain on the leaps, it kind of worked out, right? It worked out well in the end. So this is one option that you can take if you feel strongly about the underlying stock that is going to go up. So one thing to take note of is because I have a very long-term call leaps, all right? This call leaps is over a year in expiration date. So I was willing to go for a loss for my covered call because I know that in the long term, I feel that the UNH will go up. Alright, so that's it for exit strategy number 3. Now the last exit strategy is based on profit per day. So basically the idea is to close your covered call when the profit exceed the daily average profit. Okay, so let me just give you an example. So let's say for example you sold a covered call for $3 with a days to expiration of 30. Alright, so in 30 days this covered call will expire. So what is your average profit per day? So you simply just take the profit, or rather the premium, you divide it by the number of days expiration, so you know that $10 is your average profit per day. So on a rough gauge, what I want to see is that I make $10 every day, all right, in terms of profit, all right, on average. So if this profit actually goes past the $10 mark, then I know that I'm actually making more than the average profit that I would make. So in this point of time, if I make more than the average profit, I will decide to close. So for example, this is the cumulative profit. This is the days to expiration on your option. Okay, so for example, on the very first day you initiate it, you see that it's $3. All right, you sold it for $3, and then yes, 30 days to expiration. All right, so this is on the day you sold the covered call. Now 5 days later, right, 5 days later, your cumulative profit should be $50. So let's say for example, you take a look at your option and you notice your option is worth $2.70. So you sold it for $3, and then you look at the value now, it's only $2.70. So what does it mean? It means that after 5 days, you only made how much? $30 in profit, right? But then based on the average daily profit, you should be making $50. So in a sense, your covered call is falling behind in terms of the profit. So at this point of time, you don't bother to close it, right? You can just hold on to it. So now another 5 days has passed, so total 10 days has passed. So 10 days has passed, your cumulative profit should be $100, right? So it should be by now decayed from $3 to $2, right? But let's say if you take a look at it and it says $2.20, so what does it mean? It means that you only made how much? $80 on your covered call because you sold it at $3, and if you were to close the position right now, it will be $2.20 only. So your profit is only $80. So you're behind in terms of profit. So I wouldn't close my covered call because of this. Now let's say 15 days have passed since you sold it. So you should be making $150. Now this time, let's say the market really dropped, right? The market sold off, and then you take a look at your covered call now, and you see that your covered call, instead of $3, it's now only worth $1. You sold at $3. Now if you were to close it, you would make if you close it, it will be $1. So what is your profit if you close now? So the profit is $200. So look at this. right now, if you close it, you will make $200. If you take a look at the daily average profit based on 15 days later, you should be making only about 150. So that means now you have made more than what you should be making on an average daily profit. So this is where you can decide to say, oh, I've already made about $200 out of $300 premium in just half of the time, in just 15 days. What this means is that if I wait another 15 days, right, all the way to DTE 0, if I wait another 15 days, all I can make is only an additional $1, right? So you want to ask yourself, do I want to take the risk, right, when I've already made 2/3 of it in just half the time, and then I have to wait another half the time, another 15 days, just to realize the last 1/3? So this is a question only you can answer, but generally it doesn't make sense, because what if the market rallies back up to your cover call? Then you would have lost this profit, right? So at this point of time, you could say that, all right, I've already made more than the average daily profit. That means I can close it out. So this is basically what it means by closing your cover call based on profit per day. So I'll just give you an example. So just only yesterday, on the 29th of July, Amazon, right, it gapped up based on earnings. Okay, so it gapped up pretty big, as you can see down here, and then I managed to sell a cover call at the 150 strike price for $1 a piece. I sold about 3 cover calls. So today, which is a weekend, on Saturday, when I open up the platform, I noticed that the price of this cover call has already dropped to roughly around 51 cents. So that means I've already made 50 cents, close to 50 cents in just one day. And the expiration date when I sold this cover call is DTE 21. That means there is still 20 days left to expiration. So think about this. I've already made 50% of the cover calls premium in one day. Should I wait another 20 days just to realize the remaining 50 cents, 50%? Should I do that? Now, it doesn't make sense, right? Because I would most likely be risking it, because in case if the market decides to shoot up again in the next 20 days, then I've lost this profit, right? So a better option would be to just close it out when the market opens on Monday. I can close it out, and once I close out, if the market decides to go up again, I can choose to sell another cover call again later on. Alright guys, so I hope this video has been helpful, and if it has, I would appreciate it if you would subscribe and also give me a thumbs up. Alright guys, as always, I thank you for watching. I appreciate your time, and may the options favor you.